This session is on depreciation. Firstly, let's start with what is depreciation. When a business buys an asset, such as a vehicle or equipment, they intend to use that asset over a number of years. But as they use it, this asset loses value. Think of your car, if you have a vehicle that you use on a daily basis. When you bought the vehicle, it was worth a certain amount of money. But as you drive it and you drive more kilometers and the odometer shows a higher kilometer reading, the value of that vehicle becomes less until eventually it comes to a point where you can either say that you can't use the vehicle anymore, or the vehicle is worth nothing, or maybe you want to sell it second hand for a much lower value than what you bought it at full time. This loss that the asset has, and in the business it could be equipment, it could be machinery, it could be anything, any fixed asset that the business uses, this loss has to be allocated to the financial period in which that item or that asset was used to generate income. So if I'm using a truck this year as a delivery vehicle, and there is depreciation that needs to be written off on this vehicle, then it needs to be done in this year that I used it in order to generate income, maybe to generate sales if I have products that I sell, and then I deliver them, and that delivery vehicle's loss of value then has to be attributed to this financial period. The depreciation that we calculate for that period is seen as an expense. So it gets recorded in the income statement under the expenses section. But remember now we've said that the asset actually decreases in value. So in the balance sheet, we will also show that value that gets decreased as an accumulated depreciation. Accumulated depreciation is all the depreciations we've written off over a number of periods in total, and when we subtract that from the cost price of the asset, we're left with something we call book value. And the book value is the value that is seen in the balance sheet, and that is a reflection of what that item is worth at that stage. It is important to note, however, that even though we see depreciation as an expense, it is seen as a non-cash item. Because we actually don't issue a check to pay somebody, it's just a reduction of the profit because of the value of the asset that gets that is less now. So it's not a cash item because no check is issued, but it is an expense. So it shows in our income statement under the expenses section, but we didn't actually issue a cash for it or pay it via EFT or anything like that. We didn't physically pay out any money, so it is seen as a non-cash item. Sometimes it's possible for the asset to have a resale value at the end of its life. For example, your car, your vehicle. When you've, let's say after 10 years you decide to sell it, then you can still get some money for it. That value will differ depending on the value of the asset and how much depreciation you've written off. But at the end of the day, this amount is called the residual value. And this amount is deducted from the cost price before we work out depreciation. Look at the different methods that can be applied to calculate depreciation. The first one is called the straight line method. The straight line method assumes that an equal or a fixed amount of depreciation is written off each year over the life of the asset. That means that the amount of depreciation we write off every year is exactly the same over the lifetime of the asset. Remember now we said that if there's a residual amount, then you first deduct that from the cost price before you work out the depreciation. The other method that we can use is the diminishing or the reducing balance method. As the name says, the amount reduces every year because of the value of the asset reducing every year. So in this case, we then write off depreciation based on the calculation of a fixed percentage of the book value. And we've already seen now that book value is the cost price minus the accumulated depreciation. In other words, the total of all the depreciations which you've written off so far over the life of the asset. Essentially, this means that more depreciation is written off earlier in the life of the asset. And the reason for this is that as an asset gets older, it most likely requires more repair expenses in later years. Think of your car, the older it gets, the more things you have to replace on a more regular basis. So if they write off the depreciation earlier in the life, then they recoup most of the value of that asset earlier on, and they can then use that in order to pay for the expenses later on. Let's have a look at some examples in practice of these two methods. Firstly, the straight line method. Typically, a question would look as follows. Monster Traders bought a new truck on the 1st of June 2011 for 150,000 Rand. It is estimated that the truck will have a residual value of 20,000 Rand. Depreciation on vehicles is calculated at 20% per annum on the straight line method, and the company's year ends on the 28th of February. Okay, so let's have a look at what information they gave us. Firstly, they told us when we bought the truck, 1st of June 2011. They told us how much we bought it for, so the cost price of the truck is 150,000. They tell us that there will be a residual value, and that value is 20,000. They tell us that we have to calculate depreciation using the straight line method, and that it's calculated at 20%. Now, don't get confused with the percentage and the fact that it says straight line method. If it's 20% per annum straight line method, then effectively it means that the vehicle, in this case the truck, will be written off over a period of 5 years. Because 20% times 5 gives you 100%. So all the 100% of the value of the truck will be written off over 5 years if you do it 20% per annum. And then they told us that the company year ends on 28th February. This is important because we write off depreciation at the end of a financial period. So it doesn't matter when you bought the truck, you will work out the depreciation or calculate the depreciation at the end of each financial period. So typically, the question that they could add in here would be as follows. Calculate the depreciation on the new truck as at 28 February 2014 using the below table. And then they will give you a table that looks like this. Date, cost price, depreciation, accumulated depreciation, and book value. It's much easier to do the depreciation calculation using this table, so I would suggest that even when they do not give you the table, that you draw up the table for yourself in this format in order to make the calculation easier. Also remember that the table will only show the amounts as you've calculated them. So you still need to show your calculations separately so that the examiner can see how you got to those amounts. So using this information now, let's go and calculate the depreciation for each year from the 1st of June when we bought the truck up to the 28th of February 2014. Firstly, let's do the calculations for each year. If we bought the truck on the 1st of June 2011 and our financial year ends on the 28th of February, then the first time that we will write off depreciation will be 28 February 2012. Remember now that there's a residual value, so when we work out depreciation, we first have to deduct that residual value from the cost price before we can use that amount to work out depreciation. So you'll see in the calculations there, we start with 150,000 minus the 20,000. So it's cost price minus residual value. And then we're going to multiply it by our depreciation percentage of 20%, but because the first time I calculate depreciation, it's not for a full year, I then have to find out how many months I have to write off depreciation for. Remember, the 20% is per annum or per year, so the 20% is for a full year. But the first time I write off, I don't have the asset for a full year yet. I only bought it on the 1st of June 2011, and I'm calculating depreciation on the 28th of February 2012. Okay, so let's have a quick look then at how to count. If I bought it on the 1st of June, then I have to write off for the month of June, July, August, September, October, November, December, January, and February, because we write off until the end of February. So that gives me 9 months. If I count it, it's 9 full months. And therefore, when I work out the 20%, I have to multiply it by 9 over 12. 9 months out of the 12 months, because remember, the 20% is for a full year. So I need to work out the fraction of what it will be for the period I've had the truck so far, and that is 9 months, 9 over 12 months, because there's 12 months in a year. So when I then multiply that with 130,000, which is the cost price minus the residual, I get an amount of 19,500. So the first time I write off depreciation on this vehicle, I write off an amount of 19,500. The next time I write off depreciation, it is for a full year. So on the 28th of Feb 2013, I then have an amount of 26,000. And how did I get that? Well, firstly, again, I start with cost minus residual, so 150,000 minus 20,000, and that I can now multiply with the 20% that I write off depreciation per annum. Because it's been a full year, I can write off the full 20%, and 20% times 130,000 is 26,000 rand. The next year, 28th February 2014, is also a full year, and exactly the same calculation will be done. So the depreciation that I write off for the year ending 28th February 2014 is another 26,000. So you'll see, if I then want to know in total how much depreciation I've written off over the period or over the life of the truck from when I bought it in 2011 up to 2014, you would literally then add 19,500 with 26,000 with another 26,000. But let's do this by means of the table that I gave you, and then let's see what the table would look like if I had to fill it in. Okay, so the table starts with the date. The first date then is 28th of February 2012. The cost price always stays the same. The cost price is 150,000. The fact that I deduct the residual value in order to calculate the depreciation doesn't mean that the cost price of the vehicle changes. It simply means that the book value will change at the end, because I'm working out the depreciation on a reduced amount. So in this case, if I then have to plug in the amounts I have worked out, the depreciation for that first 9/12 of a year is 19,500 rand, which simply means that my accumulated depreciation is exactly the same amount. There has been no depreciation before that, so the depreciation expense and the total depreciation I've written off over the life of the truck is the same, because it's the first time I'm writing off depreciation. The book value is always cost price minus accumulated depreciation. So in this case then, at the 28th of February 2012, the book value is 150,000 minus 19,500. It is not 130,000 minus 19,500, because the cost price is 150,000. So the only time when you deduct the residual value is when you calculate the depreciation for each year. On the 28th of February 2013 now, my cost price again is 150,000. That stays the same, it does not change. The depreciation for the second year we've worked out at the top there is 26,000, which now means that my accumulated depreciation is 45,500. How did I get that? Well, the previous year's accumulated depreciation was 19,500, and this year I wrote off an additional 26,000. So if I add 19,500 to 26,000, then I get a total of 45,500. To find the book value now, again, I have to take the cost price and deduct the accumulated depreciation from there. So for the second year, it's 150,000 minus the 45,500 Rand accumulated depreciation, and that gives me a book value of 104,500. In the third year, in other words, at the end of 28 February 2014, cost price is still 150,000. The cost price of the vehicle never changes. Depreciation, again, if we look at the top, we've worked out that it's 26,000 for the year. And the accumulated depreciation then is the sum of the previous accumulated depreciation plus the new depreciation that I've written off in this year. In other words, it is 45,500 from the previous year plus the 26,000 from this year. So that gives me a total of 71,500 Rand. To get the book value, you remember now already that we say book value is cost price minus accumulated depreciation. So it is 150,000 minus the 71,500, and that gives me a book value of 78,500. Okay, just to check that we are correct, what you can do is multiply the 26,000 that you worked out the depreciation is per year by 5, because we previously said that the lifespan of this truck is 5 years because we write off 20% every year. 26,000 times 5 gives me 130,000, and that is exactly the amount that is left if you deduct the residual from the cost price. So that is exactly the amount that we want to write off in total. So in this case then we've tested ourselves and we've made sure that we have the correct calculation for depreciation annually, and it is correct because if I've written off 130,000 worth of depreciation, in other words 26,000 times 5 years, then I end up with 130,000, which if I deduct that from my cost price leaves me with a 20,000 residual, and that is the value that I'll get back when I sell the asset at the end of its life. Okay, so that is the straight line method. Just to recap, what happens in the straight line method is the same amount of depreciation gets written off every year, but remembering that if there's a residual, you first have to deduct the residual value from the cost price before you can work out the depreciation, and that's because I'm going to get the residual back at the end of the life, so I can't write off depreciation on it. And the second thing I have to remember is that if it's not a full year for which I write off depreciation, then I have to go and work out what the fraction is I have to multiply the percentage with. In this case it was 9 months, so it was 9 over 12. So those are the things that you have to keep in mind when you do the straight line method. Let's now have a look at the other method, which is the reducing balance method. This works a little bit differently. Typically the information they could give you will look as follows. M&M manufacturers bought a machine for 800,000 Rand on the 1st of July 2009. It is company policy to depreciate the machine using 25% per annum on the reducing balance method of depreciation. The company's financial year ends on the 30th of June. So again, let's just see what information they actually give us. They told us that we bought the machine on the 1st of July 2009. They told us that we bought it for 800,000, so that's the cost price. They told us that we have to use a percentage of 25% to write off depreciation, but they also told us that the method we have to use is the reducing balance method. And then they told us that the company's financial year ends on the 30th of June. So in this case, if you look, you'll see that we bought the machine on the 1st of July and our financial year ends on the 30th of June. That means in this example, for the first year's worth of depreciation will be for a full year. Okay, so typically the question that will follow is as follows. You are required to draw up the depreciation schedule from when you bought the machine until the 30th of June 2012. Okay, so what they're saying is they want to know what depreciation we've written off from the 1st of July 2009 up to the 30th of June 2012. They say do the depreciation schedule, which means that they do want to see the accumulated depreciation amount, and they also want to see the book value amount. When they don't give you the actual table, remember I've said previously that it would be a good idea for you to use exactly the same table just to make it easier for yourself to structure the information that you have to give the examiner. Because at this stage you don't really know what they will allocate marks for. So it's best to then give the whole table and the examiner can decide where they want to allocate marks. Further, remember that you also need to show the calculations. You need to show how you got to the depreciation amounts, because you can't necessarily do that in the table. In the table you'll only give the actual amounts, but you have to show how you got to those amounts, because that could actually count marks. So let's look at the solution then that we would use in this example. Firstly, let's look at the depreciation calculations. We bought this vehicle on the 1st of July 2009. So the first year that we'll write off depreciation is 30th of June 2010. Remember we said our financial year ends on the 30th of June every year. So on the 30th of June 2010, I will write off the first set of depreciations. The depreciation for that first year, in this case there's no residual value, so you will work with the cost price, and the cost price is 800,000 Rand. And on that you will work out 25% depreciation. That's the percentage they gave you, and because it's reducing balance, it does not mean that the depreciation will be the same every year. And we'll see now why that is. So for the first year, on the 30th of June 2010, you will then calculate 25% of the 800,000, the cost price, and that gives you an amount of 200,000 Rand. So in the first year, I'm going to write off depreciation to the value of 200,000 here. 200,000 Rand, sorry. In the second year, because I'm using the reducing balance method, I now have to reduce the value of the asset by the depreciation I've already written off on it. So on the 30th of June 2011, the amount I'm going to use is not 800,000, it is 800,000 minus the 200,000 depreciation I've written off the previous year. So it's actually 600,000 times by the 25%. The percentage stays the same. That's the set percentage at which I write off depreciation every year. But the fact that I'm using the reducing balance method means that my cost price reduces every year by the amount of depreciation I've written off the previous year. So in this case, it is 600,000 times 25%, which gives me 150,000. So you'll see now already, in year 1 I wrote off 200,000 for the year, but in year 2 I only wrote off 150,000. That is because I reduced the balance on which I work out the depreciation. So earlier in the life of the vehicle, of the machine, I write off more depreciation than later on. Okay, so year 3, the calculation would then look similar. On the 30th of June 2012, I will now use a reduced balance again. So the previous year I had 600,000, now I'll have 600,000 minus whatever depreciation I've written off, and the previous year I wrote off 150,000. So for year 3, the amount on which I'm going to calculate depreciation is the 600,000 minus the 150,000 depreciation I wrote off the previous year, and that I multiply with 25% to give me an amount of 112,500. So again, you'll see that my depreciation expense for the year decreases. First it was 200,000, then it was 150,000, and now it is 112,500. So as the balance reduces, in other words, as the value of the machine reduces, so does the amount of depreciation that I calculate and write off on the machine every year. As opposed to the truck in the previous example, where the depreciation stayed the same amount every year. So on the reducing balance method, the balance of the value of the truck reduces, but the amount of depreciation also reduces because of that. Okay, so if I had to then do the schedule using the table I've used before, it would look something like this. On the 30th of June 2010, the cost price was 800,000. That never changes. Depreciation expense for the first year we had worked out, or we had calculated at the top, was 200,000, which means that for the first year the accumulated depreciation is also 200,000. There was no previous depreciation, so the total depreciation written off over the life of the machine is the same as what I wrote off for that year. That gives us a book value of 600,000. How do we get book value? Book value equals cost price minus accumulated depreciation. So 800,000 minus 200,000 gives me a book value of 600,000. In year 2, on the 30th of June 2011, our cost price is still 800,000. That does not change. The depreciation expense now, the amount that I've written off for that year specifically, is 150,000 as per my calculation at the top. And that now gives me an accumulated or a total depreciation written off to date of 350,000. How did I get that? Well, it's the 200,000 from the previous year plus the 150,000 from this year. So 200 plus 150,000 gives me 350,000. So that will then give me a book value of 450,000. Book value equals cost price minus accumulated depreciation. So it is 800,000 minus 350,000, and that gives me a book value of 450,000 rand. In year 3, on the 30th of June 2012, my cost price is still 800,000. That does not change. The depreciation expense for that year, if I look at my calculations at the top, it was 112,500, which means that my accumulated depreciation now is 462,500. How did I get that? Well, it's the accumulated depreciation from the previous year, in other words 350,000, plus the depreciation I wrote off for this year, 112,500. So 350,000 plus 112,500 gives me 462,500. That then leaves me with a book value of 337,500. How did I get that? Again, book value equals cost price minus accumulated depreciation. So it's 800,000 minus 462,500, and that leaves me with a balance of 337,500. So you'll see in this case then, what is important to note? Well, firstly, when I do my depreciation calculations, I must remember that the value on which I do it reduces every year by the total amount of depreciation I've written off on the vehicle or the asset up to that date, and that means that the amount of depreciation I write off will also reduce every year. And I use a fixed percentage, so at this stage we don't know how long the life of the machine is. We will only know that when we keep on taking off the depreciation and we get to a book value of 0. So it differs in the sense with the straight line method in that we don't really know from the beginning how long the life of the asset is going to be. Okay, I hope you understand depreciation a little bit better now.